It always starts the same way.
Euphoria, growth, record profits, and the illusion that this time will be different. But every market bubble in history has ended the same way too, with panic, collapse, and regret. What if I told you that the same storm that wiped out fortunes in 1929 is quietly forming again, right now, in 2025? And this time it could be even worse. To understand how we got here, you have to rewind. Back to 2020, the world shut down, economies froze, and governments panicked. The Federal Reserve printed money at a speed never seen before in history. Trillions of dollars were created out of thin air to save the economy. But what they really did was inject pure adrenaline into a patient that was already addicted to easy money. The result? Artificial growth. Stocks, crypto, real estate, everything exploded in value. By 2021, investors weren't asking if assets were overvalued. They were asking how fast they could buy more. Retail traders became overnight millionaires. Corporations borrowed billions at near-zero interest, and inflation quietly started its climb. But like every drug, the high could not last forever. By 2023, inflation was still roaring. To cool it down, the Fed began raising interest rates, the very needle that pricked the bubble they had inflated. The cost of borrowing soared, mortgage rates doubled, and tech companies that were once untouchable started laying off workers by the tens of thousands. The Nasdaq lost trillions in value. But still, the market refused to crash. Why? Because everyone believed the same lie, that the Fed would pivot, cut rates again, and save them once more. But here's the uncomfortable truth. The Fed is trapped. If they keep rates high, the economy collapses under the weight of debt. If they cut them, inflation comes roaring back. Either way, someone pays the price. And history shows who that someone usually is, the middle class. Now let's connect the dots. Every major market crash in history, from 1929 to 2008, followed the same pattern: cheap credit, speculative mania, and extreme overvaluation. Right now, all three are back, but on steroids. Corporate debt is at record highs. Personal debt has surpassed $18 trillion. And global stock valuations are at levels we haven't seen since the dot-com bubble. But what makes this one uniquely dangerous is the illusion of safety. See, after 2020, millions of new investors flooded into the market, but not through brokers or advisors. Through apps, zero-commission trading turned speculation into a game. Meme stocks, crypto hype, and TikTok investment gurus turned finance into entertainment. The result? A generation of investors who have never experienced a true bear market, convinced that every dip is a buying opportunity. But when the real crash hits, they will learn the hardest lesson in finance. Liquidity disappears faster than it arrives. Meanwhile, corporations use cheap debt not to innovate, but to buy back their own shares. Stock prices went up, executives got richer, and companies looked profitable on paper. But beneath the surface, productivity was stagnating, wages were flat, and consumers were drowning in debt. The entire system became dependent on constant growth, a treadmill that can stop moving without throwing everyone off balance. Now here's where it gets dark. The same signs that warned of the 1929 crash are flashing again. Back then, stock prices rose far faster than company earnings. The same is happening today. Back then, investors borrowed money to buy stocks. Margin debt skyrocketed. Today, margin debt is again near record highs. And just like then, the average investor believes that this boom can last forever. But look closely. The cracks are already forming. Real estate prices are starting to fall in key markets. Corporate bankruptcies are up more than 30% year over year, and global shipping demand has dropped sharply. The credit cycle is turning, and liquidity, the lifeblood of modern markets, is drying up. And here's the most chilling part. When liquidity vanishes, everything falls together. Stocks, bonds, real estate, even supposedly safe assets. That's what happened in 1929, in 2008, and that's what could happen again in 2026. The catalyst? It could be anything: a debt default, a credit crunch, or even a geopolitical shock. But it doesn't matter what starts the fire when the entire forest is already dry. Here's where most people make a fatal mistake. They think crashes happen overnight. They don't. They build up slowly, quietly, behind the scenes, until one small event triggers the avalanche. And right now, the snow is stacked higher than ever. In the next part, we'll break down exactly how this crash could unfold, who will get hurt first, and how a few people could actually come out richer than ever. just like a small group did in 2008 when everyone else lost everything. Before we move on, if you're serious about understanding the forces shaping your money and your future, make sure you stay till the end, because once the dominoes start falling, there will be no time to react. The warning signs are everywhere, but most people will not see them until it is too late. The 2026 crash will not look like 2008. It will be faster, sharper, and more psychological. Because this time the markets are not just inflated, the belief system behind them is. To understand how it happens, you need to follow the money. For the last decade, global markets have been propped up by one thing: cheap debt. Every time the system faltered, the Fed stepped in to inject liquidity. That created a dangerous illusion, the idea that the government can always prevent a crash. But here is the reality. Every injection of liquidity makes the next collapse even worse, because it pushes the system further from equilibrium. Here is how the dominoes could fall. First, interest rates stay high. Companies that borrowed heavily when money was cheap suddenly find themselves unable to refinance. Their old loans mature, new credit becomes expensive, and defaults begin to rise. At first, the headlines will downplay it. A few bankruptcies here and there. A few layoffs in tech or real estate. But behind the curtain, a credit freeze will start spreading, just like in 2008. Second, consumer spending collapses. Credit card debt has already crossed historic highs. Auto loan delinquencies are rising. Once the job market starts cracking, people will stop spending. When spending stops, earnings fall. When earnings fall, stock prices crumble. It is a chain reaction that feeds on itself. Third, the market panic begins. A big company, maybe a major bank or hedge fund, blows up overnight. Investors rush to withdraw their money. Markets tank 10% in a week. Margin calls hit. Funds liquidate positions. Panic spreads from Wall Street to Main Street in hours. That is when the crash becomes real. But here is the twist. The people who will lose the most are not the rich. It will be the middle class. The average investor with a 401k, a mortgage, and a little crypto on the side will see their wealth vanish in days. Because while they were being told to buy the dip, the smart money was already quietly moving out. The elites have seen this movie before. They know how it ends. That is why, right now, while retail investors are still celebrating small market rallies, institutions are hoarding cash, cutting exposure, and investing in hard assets like gold, land, and energy. They are preparing for what comes next, the wealth transfer. Every crash is not just a destruction of wealth. It is a transfer of it. The money does not disappear. It changes hands. In 2008, while millions lost homes and savings, a few hedge funds made billions betting against the system. In 2026, the same pattern will repeat. Those who understand the cycle will get richer. Everyone else will be left behind. So how do you prepare? How do you make sure you are on the winning side when the dust settles? First, you must stop believing that the government or central banks will save you. They will not. Every promise of stimulus, bailout, or intervention only delays the inevitable. The real safety lies in assets that cannot be printed. That means real cash reserves, commodities, and productive investments, not speculation. Second, pay attention to liquidity. When the crash begins, liquidity evaporates first. That means stocks that were easy to sell become impossible to exit. Having access to cash, real, usable cash, gives you power when everyone else is desperate. The best opportunities always appear when others are forced to sell. Third, look for asymmetric bets. These are positions where the downside is limited, but the upside during a crash is massive. That could mean short positions, inverse ETFs, or even strategic options trades, but only if you truly understand them. The people who made fortunes in 2008 were not lucky. They were prepared, disciplined, and patient. Now, let us look at the psychology of the coming collapse, because this part will decide who survives it. In every crash, there are 5 stages: denial, fear, panic, capitulation, and recovery. We are currently between denial and fear. Denial is when investors convince themselves that the dip is temporary. Fear is when they start checking prices every hour. Panic is when they start selling at any cost. Capitulation is when they give up completely. Recovery comes later, but by then, the opportunity is gone. If you can stay rational when everyone else loses their mind, you win. The market rewards patience, not emotion. The crash will not destroy everyone. It will only destroy those who built their wealth on emotion, debt, and blind faith in the system. Now, you might be wondering, how big could this crash really be? Some economists believe it could wipe out 30 to 50% of global equity value. Others say it will rival 1929 in scale because of how deeply everything is interconnected. Remember, in 1929, it took less than 3 years for the Dow to fall 89%. Today, with algorithmic trading and digital panic, it could happen in months. And when that happens, the narrative will shift instantly. The same experts who told you everything is fine will suddenly appear on TV saying no one could have seen this coming. But the signs were always there: the record debt, the inflated valuations, the blind optimism. Now let us talk about opportunity, because every collapse creates a rebirth. After 1929, those who stayed liquid bought assets for pennies on the dollar. After 2008, the people who bought real estate at the bottom became millionaires within a decade. The same will happen again. When fear dominates, prices disconnect from reality. That is when fortunes are made. The strategy is simple but brutal. Wait for panic, then buy quality. Focus on assets that will survive the storm. Companies with real cash flow, essential commodities, and innovations that will still matter after the chaos. Avoid speculation, hype, and leverage. In crashes, leverage is death. The biggest mistake people make is thinking that wealth is created during booms. It is not. Wealth is created during crashes, but only for those who are ready. The question is, are you? Because right now, the game is being reset. The bubble that began in 2020 is reaching its limit. The economy cannot sustain this level of debt, this level of inflation, or this level of denial. When the correction comes, it will be swift and merciless. So when you see the headlines in 2026 about markets plunging, banks freezing withdrawals, or currencies collapsing, remember this moment. You were warned. The question is not if it will happen. The question is, who will be ready when it does? Because for a small group of people, the 2026 crash will not be a tragedy. It will be the greatest wealth transfer of their lifetime. And if you understand the system, stay calm when others panic, and move when others freeze, that group could include you.